What if your money worked harder than you do? What if, while you were sleeping, on vacation, spending time with your family, or doing literally anything else, your investment portfolio was quietly generating income and depositing it straight into your account? That is not a fantasy. That is dividend investing. And it is one of the most powerful, time-tested, and reliable wealth-building strategies ever created. The greatest investors in the history of the stock market, from Warren Buffett to John D. Rockefeller, have built extraordinary fortunes on the simple principle of owning businesses that pay you to own them. And the best part? You do not need to be a millionaire to start. You do not need a finance degree. You do not need to watch stock tickers all day. You just need the right knowledge, the right strategy, and the discipline to stay consistent. I am Mano, and in today's video, I'm giving you the complete guide to dividend stock investing, from absolute beginner basics all the way to advanced strategies used by seasoned income investors. We're covering what dividend stocks are, how they work, how to evaluate them, the best sectors to find them, the most powerful dividend strategies, the mistakes to avoid, and exactly how to build a dividend portfolio that generates real passive income. This is the dividend investing masterclass you never got in school. So get comfortable, because we are going deep. Let's go. Let us start at the very beginning, because a solid foundation changes everything. What is a dividend? A dividend is a payment made by a company to its shareholders, the people who own stock in that company. It's essentially the company sharing a portion of its profits directly with its owners. Think of it this way. When you buy a share of a dividend-paying company, you become a part owner of that business. And as an owner, you're entitled to a share of the profits that business generates. The company takes a portion of its earnings and distributes it to shareholders, usually on a quarterly basis, though some companies pay monthly or annually. How are dividends paid? Dividends are typically paid in cash, deposited directly into your brokerage account. Some companies also offer stock dividends, paying you additional shares instead of cash. And then there's the DRIP, the Dividend Reinvestment Plan, which we'll cover in detail later, because it's one of the most powerful wealth-building tools available to everyday investors. What is a dividend yield? Dividend yield is the annual dividend payment expressed as a percentage of the stock's current price. For example, if a stock is trading at $100 and pays $4 in annual dividends, the dividend yield is 4%. This is one of the most important metrics in dividend investing, but as we'll discuss, chasing the highest yield without understanding the underlying business is one of the biggest mistakes investors make. Why do companies pay dividends? Companies that pay consistent dividends are typically mature, profitable, and financially stable businesses. They generate more cash than they need to reinvest in growth, so they return the excess to shareholders. This is a sign of financial health and management confidence in the sustainability of the business. Paying dividends also attracts a loyal, long-term shareholder base, investors who provide stability rather than speculative trading volatility. Here's where dividend investing goes from interesting to absolutely mind-blowing when you look at the actual numbers behind the strategy. The power of compounding dividends. Studies of long-term stock market returns consistently show that dividend reinvestment accounts for a massive portion of total stock market returns over time. In fact, research has shown that over multi-decade periods, reinvested dividends can account for the majority of an investor's total return, even more than the price appreciation of the stocks themselves. Let me give you a simple illustration of what this looks like in practice. Imagine you invest $10,000 in a portfolio of dividend stocks with an average yield of 4% and average dividend growth of 6% per year. In year one, you earn $400 in dividends. You reinvest those dividends, buying more shares. Now, in year two, you're earning dividends on a slightly larger number of shares, and the cycle continues, compounding quietly, relentlessly, year after year. Over 20 to 30 years, this compounding effect produces results that seem almost impossible when you first look at them. That initial $10,000 investment, with dividends consistently reinvested and the portfolio growing at a moderate rate, can grow into a figure that most people never achieve through savings alone. Dividend growth beats inflation. Another critical advantage of dividend investing, particularly with dividend growth stocks, is inflation protection. The best dividend companies raise their dividends every single year. When your dividend income grows faster than inflation, your purchasing power actually increases over time, rather than being eroded by rising prices. This is why dividend investing is not just a wealth-building strategy, it's a financial security strategy, particularly powerful for retirement planning. Now let's get into the analytical side, because not every dividend stock is a good investment. Here are the 5 critical metrics you must understand before buying any dividend stock. Metric 1. Dividend yield. Dividend yield tells you how much income you receive relative to the price you pay. A yield of 3 to 5% is generally considered healthy for most sectors. Yields above 7 or 8% should raise a red flag, because extremely high yields often signal that the stock price has fallen sharply due to underlying business problems, making the dividend unsustainable. Remember, a high yield is not always a good thing. Always ask why the yield is high. Metric 2. Dividend payout ratio. The payout ratio tells you what percentage of the company's earnings are being paid out as dividends. A payout ratio of 40 to 60% is generally sustainable. The company is paying a meaningful dividend while retaining enough earnings to reinvest in growth. A payout ratio above 80 or 90% suggests the dividend may be at risk. The company is paying out almost everything it earns, leaving little buffer if earnings decline. A payout ratio above 100% means the company is literally paying more in dividends than it earns, which is mathematically unsustainable. Dividend growth rate. Consistent dividend growth is arguably more important than the current dividend yield. A company that has grown its dividend by 7 to 10% every year for the past decade is demonstrating something incredibly valuable: sustainable profitability, sound financial management, and genuine commitment to rewarding shareholders. Look for companies with 5, 10, or even 25-plus years of consecutive dividend growth. These companies have proven they can maintain and grow dividends through recessions, market crashes, and economic disruptions. Free cash flow. Free cash flow is the actual cash a company generates after paying for its operating expenses and capital expenditures. This is the real money available to pay dividends, not accounting profits, which can be manipulated. Always check that a company's free cash flow comfortably covers its dividend payments. A dividend backed by strong, growing free cash flow is a dividend you can count on. Debt levels. A company carrying excessive debt is a risk to its dividend, because in tough times, debt obligations come before dividend payments. Look at the debt-to-equity ratio and interest coverage ratio. Companies with manageable debt levels, strong credit ratings, and the ability to service their debt comfortably across economic cycles are the ones whose dividends will still be flowing into your account when times get tough, and that's exactly when you need that income most. Not all sectors are created equal when it comes to dividend investing. Here are the 6 sectors historically most associated with reliable, high-quality dividend stocks. Utilities. Electric, gas, and water companies provide essential services that people need regardless of economic conditions. Revenue is highly predictable, regulated, and stable. This makes utilities some of the most reliable dividend payers in the market, though growth tends to be modest. Consumer staples. Companies producing everyday essential products: food, beverages, household goods, personal care products. People buy these products in good times and bad. The pricing power and brand loyalty of the strongest consumer staples companies support decades of consistent dividend growth. Healthcare. Aging global demographics create persistent, growing demand for healthcare products and services.
Pharmaceutical companies, medical device makers, and healthcare REITs in this sector have long track records of dividend growth supported by steady revenue streams. Financial services. Banks, insurance companies, and asset managers generate substantial cash flows that support strong dividends. The best financial dividend stocks have survived multiple market cycles and emerged with their dividends intact and growing. Energy. Major integrated energy companies and energy infrastructure businesses, pipelines, storage, and processing generate enormous cash flows that translate into substantial dividends. This sector requires careful analysis of commodity price exposure and energy transition risks. Real estate, REITs. Real estate investment trusts are legally required to distribute at least 90% of their taxable income to shareholders as dividends. This makes them among the highest yielding dividend investments available, covering everything from residential and commercial property to data centers and healthcare facilities. In the world of dividend investing, there are two elite categories that every serious income investor should know about. Dividend aristocrats are companies in the S&P 500 that have increased their dividend every single year for at least 25 consecutive years. Think about what that means. These companies raised their dividends through the dot-com crash, through the 2008 financial crisis, through the COVID pandemic, through every single economic storm of the past quarter century, and they kept raising. There are roughly 65 to 70 companies that currently hold dividend aristocrat status, spanning consumer staples, healthcare, industrials, financials, and REITs. Dividend kings are an even more exclusive group, companies that have raised their dividends for 50 or more consecutive years. These are businesses with extraordinary competitive advantages, exceptional financial discipline, and management cultures that prioritize long-term shareholder value above almost everything else. Building a portfolio that includes exposure to dividend aristocrats and dividend kings gives you a foundation of income reliability that very few other investment strategies can match. These are not exciting, high-flying growth stocks. They are the quiet wealth machines, the companies that have been making patient investors rich for generations. If there is one strategy in dividend investing that I want you to remember above everything else, it is DRIP, the Dividend Reinvestment Plan. Here's how it works. Instead of receiving your dividend payments as cash, you instruct your brokerage to automatically use those dividends to purchase additional shares of the same stock, often at no commission and sometimes at a slight discount to the market price. This might seem like a small thing, but the mathematical impact over time is extraordinary. Every dividend you reinvest buys you more shares. Those additional shares generate their own dividends. Those dividends buy even more shares, and the cycle compounds faster and faster as your share count grows. This is what investors mean when they talk about the snowball effect of compounding. A small snowball rolling down a long hill becomes an unstoppable force by the time it reaches the bottom. The key variables that determine how powerful your DRIP becomes are the dividend yield, the dividend growth rate, the length of time you stay invested, and the consistency of your reinvestment. The longer you leave it running, the more dramatic the results. Most major brokerages today offer automatic DRIP enrollment at no cost. Setting this up takes 5 minutes, and the long-term impact on your wealth could be transformational. Now I want to save you from the mistakes that cost dividend investors thousands, sometimes hundreds of thousands of dollars. Mistake number 1, chasing yield. The most common and most costly mistake. When investors see a stock yielding 10, 12, or 15%, they get excited and buy without asking why the yield is so high. Almost always, an extremely high yield is a warning sign, not an opportunity. The stock price has likely fallen because the business is struggling and a dividend cut is coming. When the dividend is cut, the stock price falls further, and you lose on both the income and the capital. Mistake number 2, ignoring dividend safety. Always check the payout ratio and free cash flow coverage before buying a dividend stock. A dividend that the company cannot afford to pay is not a dividend you can count on. Mistake number 3, lack of diversification. Concentrating your dividend portfolio in one or two sectors exposes you to catastrophic sector-specific risk. Build exposure across multiple sectors: utilities, consumer staples, healthcare, financials, REITs, to ensure that a downturn in any single sector does not devastate your income stream. Mistake number 4, selling during market downturns. Market crashes are terrifying, but for a dividend investor with fundamentally sound holdings, a market crash is actually an opportunity. Stock prices fall, which means dividend yields rise, which means you're buying more income for the same dollar during your DRIP reinvestment. Selling during downturns locks in losses and breaks the compounding cycle at the worst possible moment. Mistake number 5, ignoring tax implications. Dividends are taxable income. Qualified dividends from most U.S. stocks held for the appropriate period are taxed at favorable capital gains rates, but ordinary dividends and dividends from REITs may be taxed at higher ordinary income rates. Holding dividend stocks in tax-advantaged accounts like IRAs or 401ks where possible can significantly improve your after-tax returns. Here's the practical step-by-step framework for building a dividend portfolio from scratch. Step 1. Define your income goal. How much passive dividend income do you want to generate? Monthly? Annually? Working backwards from a specific income target gives you a clear portfolio size goal and helps you stay motivated and focused. Step 2. Choose your core holdings. Start with 10 to 20 quality dividend stocks or dividend ETFs spread across multiple sectors. Quality over quantity. It's better to own 15 exceptional dividend businesses than 50 mediocre ones. Step 3. Set up DRIP. Enroll every holding in automatic dividend reinvestment from day one. Let compounding start working immediately. Step 4. Invest consistently. Add to your dividend portfolio regularly, monthly or quarterly, regardless of market conditions. Dollar-cost averaging into quality dividend stocks over time is one of the most reliable paths to long-term wealth. Step 5. Monitor annually, not daily. Review your dividend portfolio once or twice a year. Check that dividends are growing, payout ratios remain sustainable, and the underlying businesses remain fundamentally sound. Avoid the temptation to trade frequently. Dividend investing rewards patience, not activity. Step 6. Reinvest until you need the income. Keep reinvesting dividends for as long as possible, ideally until you reach your target income level or retirement. At that point, switch from reinvestment mode to income withdrawal mode and let your portfolio pay your living expenses. That's your complete masterclass on dividend stock investing, from the very basics all the way to advanced strategies for building real, sustainable passive income. Dividend investing is not glamorous, it's not exciting, it doesn't go viral on social media, but it is one of the most proven, reliable, and time-tested paths to genuine financial freedom that has ever existed. Now I want to hear from you. Drop a comment below. Are you already a dividend investor, or is this your first time seriously considering the strategy? What's your biggest question about dividend investing? I read every single comment, and I will answer as many as I can. If this video gave you real value, and I genuinely hope it did, please hit that like button. It helps this channel reach more people who need this information. Subscribe if you haven't already. I release investing and personal finance content every single week. And if you want a deep dive on any specific aspect of dividend investing, the best dividend ETFs, the top dividend aristocrats, how to build a dividend portfolio with just $100 a month, drop it in the comments and I'll make that video next. I'll see you in the next one. Stay patient, stay consistent, and let's build wealth together.